Hello and welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, people are choosing NFOs these days, and two of them recently got huge amounts of money. So, are they the best funds? To answer that and much more, I'm joined by our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, a very common question that investors often ask is, which is the best equity fund to invest in, and how should one go about zeroing in on one?
This question primarily arises from the fact that everybody thinks that mutual funds are equity funds, and but that is not so. There are 35, around 40 kind of open-end funds. Beyond that, there are many variety as well for international fund, index fund, and all that. So that shouldn't be the starting point. The starting point should be which is the appropriate kind. Which is first you have to zero in on the right kind. Money for many years, you should look at equity. Money for few days, it should be a different kind of fund. Money for few months, different kind of fund. So your risk tolerance changes with this. Also, different level of experience, you should be choosing different kind of fund. For example, the first time investor should not be investing in an all equity fund to begin with, because the first time they witness a 30% decline in value, you put a 5 lakh rupees and it immediately becomes 3.5 lakh or something like that. You will get out of it never to come back again, and you'll be deprived of an opportunity for a lifetime. So depends. The starting point should be which is the right kind of fund, and for that I would like to give an answer that for the investing your money for few years, it should ideally be a balanced or a balanced advantage fund or a tax saving fund for any first time investor. Then comes somebody who has little bit of experience. It should be one or two multi-cap fund that will take care of it, and that is it. Money for few years and even few months, you need the money in a foreseeable future. It should only be fixed income fund, and fixed income fund also with a reasonably predictable return, and which should not give surprises. That's about it. So 3-4 kind of fund will fulfill your need, and you can ignore the rest.
So you said 3-4 funds. Shouldn't one be diversifying? Isn't that a good strategy?
No, diversification is important. Diversification you need on different levels. One is that if you are thinking only in terms of equity, your long-term money which you are unlikely to need for 5 years and more, that should be, diversification is important. Exactly the reason why you invest in a mutual fund is the reason why you should have more than one mutual fund. But having too much of a good thing is not a good thing, because what happens is if you have more than 3-4 funds, you will have diversification beyond a point. You will be incurring the cost of active management. Actively managed funds are more expensive than index fund. And having more than 3-4 funds, you will be getting the returns, or the your underlying investment will be like that of an index fund, and you will not be getting the benefit of a focus. And so diversification beyond a point is not useful. So have diversification, but not have to a point that it actually hurts you. So that is why just have 3-4 funds.
Okay, so 3-4 funds is the upper limit here.
It's the upper limit.
It's the upper limit. Okay. And what strategy should an investor follow while making an SIP investment? Specifically in the current market scenario where markets are going up every other day. So what should the strategy be?
No strategy. Just carry on with your SIP. You will be getting all kind of conflicting opinion, and if you follow any of it, you will go wrong. Even if you sometimes don't come to Value Research to get an opinion in terms of we will warn you when to get out or when to get in, because nobody can. And I can tell you with great confidence that Value Research can't. So don't look at any of those. Just carry on. The other thing to keep in mind is that, but people are still anxious. A lot of people are thinking that market will come down. A lot of people have actually expecting that the market will come down, have taken out a part of the money or whole of their money. That is a very that is a very hurtful thing to do to yourself. Nobody can guess the market. People have gone wrong, and get back into the market in a methodical way, and do some kind of active rebalancing. No long-term investor should be putting all his money into equity. You should have a part of your money, even long-term money, into fixed income. That is because that allocation to fixed income will give you an opportunity to rebalance. Your 25% into fixed income will get reduced to 10%, given that the market has gone up so sharply in recent times. So if it becomes 90%, you'll be able to take some money from your equity and rebalance it to 75% equity and 25% fixed income. So you are booking profit, but not doing this massive shift from equity to fixed income and fixed income to equity.
That was about SIPs. What should one do if one has lump sum? Should one be investing a lump sum in equities?
Never. Exactly the reason, because this is maybe we might be sounding like a stuck record, but it is worth following it. It is worth reinforcing. It is worth repeating it time and again. The biggest damage which we do, the massive blow that we get is not financial. It is the psychological. And if you invest 5 lakh rupees and it gets reduced to 3.5 lakh rupees or 4 lakh rupees in a brief period of time, and for any new investor, it's a massive blow. You get scared, and that is the kind of impression everybody carries about equity. That is the impression that everybody carries about equity fund. So, and that is my worry. All the kind of big money coming into new funds, the people are coming in with great deal of expectation, and they will be disappointed very quickly if it does not materialize. And so work on a plan, spread your money over a period of time. Even if you have any amount of lump sum, spread it over the broad principle that I follow in terms of how the time period in which you should spread your investment is normally half the time it has taken to earn you. So if you are getting your annual bonus and that has to be invested, spread it over the next 6 months or 3 months, because you'll keep getting that on an annual basis. If it's a long, it's a sizable money, it's a retirement money or some substantial thing, gratuity money which has to be invested, and you don't need to consume it, you don't need to spend it, maybe spread it over the next 3 years. Don't take it beyond 3 years. That is my upper limit. Otherwise, you'll miss on the opportunity. I think most market cycles you are able to capture in the next in a 3-year time period. The disadvantage of following my advice here is that you might miss an opportunity. If somebody had 10 lakh rupees a year and a half back, and if somebody would have followed my advice, he would have missed the opportunity of investing all his money, which would have gone up by about 20-30%. But the benefit of following this advice is that you will be working on a plan which will not disappoint you. You will not be scared at any point where you will be driven out of the market, and that is very important. If you are going to invest for a lifetime, it is worthwhile missing a small opportunity for the sake of being there for a lifetime. Otherwise, you'll be driven out of it.
Going towards debt funds, how should one choose a debt fund, and while setting up a systematic STP or SWP, how should one zero in on a debt fund?
One is that STP is a good idea in the sense that you are able to automate your investment. So if you have to invest in 2 equity fund, you divide your money, put the money in the fixed income fund, and from there give a standing instruction that okay, I have put 5 lakh rupees here, move my 40,000 rupees every month over the next 1 year. So it will happen automatically. You don't have to worry about it on a day-to-day basis. And also that money moving out of your bank account has its advantage. You don't stare at it and looking for an excuse to spend it. So that's one advantage. But don't be very fussy about this. Many a times I'm finding that a lot of people are working so hard on finding the great debt fund in which they will invest, and because you are not investing in fixed income fund to maximize your return. You are investing in a fixed income fund while you are waiting to put that money into equity. And if you are able to find a great debt fund, it is not going to make any meaningful difference to your life. You will earn 4% or 4.5%. My sense is that if you are a disciplined person, today, if you don't move your money from your bank account to your fixed income fund, it will not make a material difference, because a not so great, an average great debt fund will earn you about 5%, and your savings bank account in the largest bank will also yield you 2.5%, and that too on a reducing balance basis. First month, 1/12 of your money, assuming that you're spreading your money over the next 12 months or 6 months or whatever, depending on that. Only a small part of your money is getting invested. So it is basically, this method is all about reducing your risk, configuring your investment in such a manner that you are able to de-risk yourself from the anxiety which investments cause. And that's about it. Fixed income, so don't be very fussy about it. Yes, there is some advantage in terms of automating your investment so that it gets out of your, so just choose a standard, liquid fund or a ultra short term bond fund, and don't get into, over engineering or looking for the finest fund, because I have come across people who have, trying to look for the best. They have actually wasted 1.5 year, 2 years, 4 years maybe, and they are deprived of that opportunity. Put your plan in motion, and even if you are not with the finest plan, get with a reasonably fine good plan. That is fine, and time will take care of it. That your discipline is the most important thing in your financial success, rather than choosing the best fund or choosing the best debt fund for your STP.
Time now to move on to our viewers' questions. The first one has been sent in by Pranav. He wants to know if one should invest in international funds and how should one go about finding a good international fund.
uh, yes, one should invest in international fund, and I think one should look for that international fund. First, you should narrow the universe. There are many international funds which are not worth investing. They have been in the country, they have been available to Indian investors for many years, and they have not produced anything meaningful. They are too diversified. The oldest international fund is spread over many countries, and the oldest international fund available to Indian investors is 10-12 years old, and invested in many geographies. It has not produced anything meaningful. It is a great case for diversification which has not worked out. I would say that one should look at an international fund, but it should also be a promising investment, and a investment which you don't have access to in the Indian market. For example, when I'm looking at those those US domiciled funds, particularly the Nasdaq or the US Opportunity Fund, or you are getting exposure to a market which has a large set of globally competitive businesses, and the dominance of technology businesses which dominate in their segment. Those businesses, a great business is the one which becomes a monopoly, and you come across many of those technology led monopolies in the US, not elsewhere. Yes, you come across some great brands or consumer brands and things like that, but they are also moving target. They change with times. But technology led, dominant, innovation led such businesses, so I would say that should be the top part of your international diversification. And maybe, even there you have 2-3 kind of things available. One, you have a blend portfolio, which is very, good component of growth companies, good component of value companies, relatively available companies available cheap, and a good company, a spread of, growth and value. So that is a simple way of looking at it. If you're looking for a growth portfolio, look at all those technology, Nasdaq 100, S&P 500. I would call it a blend portfolio. Then you have this US Opportunity Fund and many other things. Don't get into anything narrow. Don't get into anything which is exotic. Because they have this. Either they are at the top or at the bottom of the league tables, which is undesirable. So choose a blend or a growth portfolio.
All right, now AK Malhotra has sent in the next question and he asks, are focused mutual fund schemes recommended for senior citizens with a medium to long-term horizon? Also, is it advisable to start SIP in mid-cap funds in the current market scenario?
They are all good options, but I would say that if they are all secondary options for you. If you are invested in 2 or 3 or 4 multi-cap fund, you don't need to consider any of these. And senior citizens or not a senior citizen, it doesn't matter. Senior citizens are of two kind. Somebody who has a 10-year experience and is not getting upset with the big ups and downs of the market, I really don't care if he's a senior citizen, because he has the tolerance. He knows that okay, this too will pass, and he has seen it 5 times in his life, and he is not getting disappointed or not getting scared, not getting upset. So that's fine. If you're a senior citizen and you have been investing just for the last 2.5 years, you have just seen one side of the cycle, then it's time to worry. So it's how experienced are you is material rather than whether you are a senior citizen or not. Because many a times I come across senior citizens who are very venturesome. I come across a senior citizen who who get large pension. They also have some rental income, and all the money that that is there in their investment, by way of investment, they are unlikely to need it. So they have infinite risk tolerance, and they are also experienced. It's not unusual to actually have a venturesome senior citizen. So don't have that notion. You can have everything, but entirely, it entirely depends on how much, how low maintenance or high maintenance you want this portfolio to be. If you want it to be low maintenance, 4 multi-cap funds will do. If you want to be little active, then have a, you know have a mid cap and a small cap and a focused fund, and maybe a multi-cap flexi cap fund. So 4 funds will of this kind. But then you will have to worry about the small cap fund, the large cap fund, the mid cap fund, because there some of these funds will do very well or they will do very poorly. And that is a time when you have to stick with that. When they do poorly, you have to stick around so that you are able to benefit that when they will do well, you still own them. So it requires temperament. I would say make your choice depending on your experience and your ability to navigate all this. Want a low maintenance, 4 multi-cap funds will do.
All right, now Ankit Jain wants to know, out of deposits in small finance bank and debt mutual funds, which is a safer option?
Both are reasonably safe. I would say that debt mutual funds are relatively safer because you have the benefit of diversification. But I'm not saying that the small deposit in a small finance bank is risky, simply because RBI has a very close supervision mechanism for them. They get a license only if they are safe, and uh, I think they are relatively new bank. They have a reputation to guard. They have a reputation to build. And so I don't think that they are unsafe, but I think debt mutual funds are far more safer, because if you have invested a lakh of rupees, it will be spread over 30 debt instruments. And if one of it actually goes wrong, it will be 5%, 7%, 8%. So all your money is not at stake when you are investing in a debt fund. Besides that, there is other thing, holding of more than 3 years, it is treated as capital gains. Then the income from 3 years and more is more tax efficient. Then when it comes to liquidity, debt fund, you decide late night, and next day, 2 days from there, it will be there in your bank account. So yeah, I don't think there's a huge compromise there, but there is a big difference between any deposit and any debt fund, is that here you get assurance of, okay, this is the return you will get beforehand, and here you are never told what you will get beforehand.
All right, now PC Garg, who is a retiree, has about 60 to 65% of his money, amounting to about 1.5 crore, in equity mutual funds. He asks which category of funds should he invest in, and how many schemes. His aim is to leave a larger estate for his children.
I think he is well geared for, he needs to do, if he is not going to depend on this investment for income, he should just carry on with this plan. 65% money in fixed income, in equity, remaining in fixed income, and he should rebalance it every time this 65% becomes 70-75%, or he should move money from fixed income to equity. If equity gets reduced to 60 or 55 or something, 5-7% variance from the 65-35 ratio, and he should be rebalancing. Not before that, not after that. And that is the way I think he will be able to add substantially more to his state for his successors.
Okay, now after his retirement, Tapash Mukherjee has reinvested his equity mutual fund investments, and he has split them equally between a balanced advantage fund and flexi cap fund through STP for 18 months. So is this the right strategy, he wants to know?
Depends, I need lot more information than just this. Yes, this is the right strategy when it comes to investing in equity, because if you put your post-retirement money in equity and after that you see a big decline, and if you have done it in the last 18 months, it is fine, because you would have seen your money getting invested gradually, and yeah, even the interim decline in between would not have scared you, and by now you would have witnessed very meaningful return, maybe 15, 18, 20% return so far with the kind of funds you have chosen. But what you exactly need to do entirely depends on what is your income expectation from this, and Is it the right configuration to generate income, or if you just want this money to remain invested and you don't have it. So it all depends on your expectation from here.
Dr. Arjun Bhatia has redeemed his investments from regular plan of mutual funds and has reinvested 90% of them in direct plans. He has retained 10% of the total value as he wants to reinvest it through SIP. But since the market is going up continuously, should he reinvest this amount as a lump sum?
Uh, my general suggestion to everybody is that, when you are investing new money, which you got from somewhere else, you should invest in equity always in a gradual way, SIP, or let the money STP or whatever. But here in your case, you have already invested the money by way of, it was already invested in equity, and now you have taken it out. So you could have just moved to equity immediately. But the real problem is that assuming that you have taken out your money and now you are anchored, your mind get anchored to a certain value. Whatever money you invested, now you know that okay, now it is 10 lakh rupees. And if you invest 10 lakh rupee today, now you will be comparing your return or the worth of your investment from that 10 lakh rupee. You won't be looking at it that okay, this is 10, you won't be looking at it as 10 lakh. You will be
Original
looking at it
amount.
10. You will not be looking at it as okay, 15,000 rupee accumulated over the last 15 years. Now your mind will be anchored to 10 lakh. So if you can actually get over that anchorage, then move all the money immediately. Otherwise, spread the money again, because if even by now, if you think that money goes down by 20% and you'll be running for cover, spread your money. If you won't, then invest lump sum.
All right.
It is actually all about managing your mind rather than I don't have a trick to tell you that which will be beneficial or not. Many a times following my advice will deprive you of some of the returns which might be otherwise be available to you.
Okay, the next question has been sent in by Dinesh Bharadwaj. He says he might need around 40% of his equity mutual fund investments depending on an uncertain event. The requirement may occur in a year or two, he says. So, what should be his plan of action?
I think the money which you require in next 1 year, 2 year, 3 year, a contingency money, likelihood, that should not be in equity in the first place. Because the money in equity should always be the money which you are unlikely to need for 5 years and more. And today is a good time to take that money out, because if you decide to take that money out and that is a time when market has gone down and it can remain at lows for a long period of time, so that will be very disappointing. Take your money out.
Sriram Ramanathan asks, why is it suggested to have an additional health insurance policy besides the one provided by his employer?
Two reasons. Primarily, if that is not adequate. If your employer is providing something like 3 lakh rupees and you think the reasonable amount should be 5 lakh rupees. The other reason generally is if it's not comprehensive enough. If you have your parents and you want a coverage for them, and your employer is not providing a coverage for them. So these are primarily the reason, and that is the reason why you should actually have it. Then there is a third benefit which happens on account of buying your health insurance yourself, is that your insurance company starts building your experience as a policy buyer. What kind of customer are you? And so you start building your track record with the insurance company in terms of a policy owner.
Okay. Now, 50-year-old S.K. Sharma is a small cap investor. What should be the allocation between small caps and fixed income in the current scenario is what he wants to know.
Small caps, fine. If you're 50-year-old, you're fine with the small caps, and you think that you have the capability, or you have the ability to withstand the big declines of small caps, because they turn out to be very rewarding. At the same time, they turn out to be extremely disappointing in the short run sometimes. When they fall so freely that they scare the hell out of everyone. So I think one should just have some kind of fixed income allocation, depending on maybe 25%, 20%. And I don't think there is any magic formula. I don't think there is any thumb rule. It should be primarily to book gains from your small. Everything goes haywire once in a while. either it goes dramatically up or it goes dramatically down. And that is when your asset allocation changes radically. That is the time when you should have the money in fixed income to be moved to equity, or money into equity, which has, your 75% will sometime become 98%, simply because it has gone up so dramatically. And that is the time when you should be able to pull back, realize a part of your gain, and you will not have deep regret. And I think that is how you will be able to optimize your return even on the small cap. So have that allocation to fixed income of some scale. Maybe 20, anything less than 10 25% will not be meaningful, because if it's 10%, you will be keep rebalancing, which will not, and you will not give it an opportunity to run.
Now, today's last question has been sent in by BR Mala. He asks, would you suggest booking partial profits from mid and small caps in the current scenario, as they're exceeding 25% of the total portfolio value?
Yes, I think I would suggest every investor to work on and write and put it in their wallet, the rule that they will follow. That this is my asset allocation, and I'll follow it at all times, and I'll check for it every month. And come to Value Research online, set up your portfolio, and you'll be able to see in a very simple way how much of your money is in equity, how much of your money is in fixed income. You can track all your investments there. So look at it every month, and if it goes up, decide on this asset allocation. Nobody does that, and I think that is going to be one of the biggest discipline that you can enforce on yourself. And that is what will save you from all the disappointment that everybody say that, okay, market went down and you could not do anything, or market went up and you are not there. That is the methodical way of doing it. Otherwise, everybody is normally looking for looking for some kind of tip, that should I get out of the market, or should I be investing in that great fund? That doesn't work, and I don't think we can help you, but we can definitely help you doing this.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions, and if you like the show, do subscribe to our YouTube channel. Bye for now. Take care.